Good afternoon, everybody. Thanks for showing up and attending. This is the third presentation by Jim and Jim Worcester, Alarm Financial Services. If you saw their first two webinars, you know how great it was. And if you didn't see it, then you're in for a treat today, because these guys put on a terrific webinar, packed with information and easy to listen to. So I'm going to assume that you've all been on before, and I'm not going to spend waste any time introducing them, really, other than to say that Alarm Financial Services is a financial a company that funds alarm companies, your acquisitions, your refinance of your accounts. They are on the Alarm Exchange. If you can't keep track of them here, you can always find them on the alarmexchange.com. And hope we hear from them a lot in our daily emails that go out. I've asked them to prepare a couple of articles for us, and I know once in a while they do respond to articles. And so I'm going to turn it over now to I think Jim Jr. is going to take over first, right? He's going to take over the screen for starters. And there you go. And the gate's opened. You're on.
All right, let's see what we can do here. All right, I think we've fired up. So thanks, Ken, and hello, everybody. This is, as Ken mentioned, the third of three in our webinar series for financing for the alarm industry. The first one that we did a week ago today was a general overview of financing. And then on Thursday of last week, we drilled down specifically on funding for an acquisition. And today, the last topic is going to be financing of organic growth. So before we jump in, let's just kind of give you a quick background on us, if there are anybody who was not part of the previous two. My name is Jim Worcester Jr., and our company, Alarm Financial Services, as Ken mentioned, provides financing for recurring monthly revenue companies that are in the security, fire, PERS industry throughout the United States. And we do that in the form of loans and lines of credit ranging from $150,000 to $1.5 million. I've been part of the business since 2002. But it pre-exists before me and was founded in 1987. We're the industry's oldest funding company. And so I'm going to pass it over to Jim Sr. to introduce himself and give you a little further background on that.
Thanks, Jim, and thank you, Ken, and thanks everybody for being here. But by the way, the name labels, Junior, so you don't mix us up, I'm Senior. And actually, my experience goes back to 1967 when I was 27 years old. And I bought a franchise for closed circuit TV and was in that a couple of years. Then I was hired to be the sales manager of a non-existent sales force in Northeast Ohio in 1969. And I sold that business to Jim Covert and Russ McInerney, Security Link, in 1986. So that's the timeline. And from that initiation in 69 to 86, we built that from one account to thousands of accounts. And at that time, the recurring revenue in today's money was about $335,000. Now, I'm not saying that I'm saying it because it's relevant, not because it's a lot of people built bigger businesses than that. And a lot of people just got really comfortable where they were, and everybody's got their own journey and story. The only reason I'm saying it is because I am in the deep veins an alarm dealer that got in the finance business. So I understand having one account and 400 accounts is several thousand. That's my background, and I'm happy to still be doing it, but not a lot. Jim.
So when we're talking about financing for the security alarm industry, it can take a lot of different shapes. We talked in depth last week about borrowing money to make an acquisition. But we also get a lot of requests for other reasons, consolidating existing debt, buying out a partner, or buying out next generation, buying out the parents. That's becoming more of a prevalent topic these days. Covering upfront costs of large projects where you don't anticipate getting paid on your initial investment of equipment or labor for quite a while. Paying off investors at some point. It might be a stage where you've had initial investors and the company's got to the point where you want to buy them out. And then the topic that we're going to dig into today on is financing organic growth. So what do we mean when we're talking about organic growth? So organic growth could be something like opening a new office, to expand into a new geographic region. It can be increasing your budget through marketing and advertising, and it can be rolling out new products and services. For example, AES radio, video monitoring, etc. It could be getting into offering commercial leases. And by offering leases, I mean not necessarily bringing in a third-party leasing company, but you being the leasing provider. It can mean finding out how to compete with $0 down or $99 companies if that's something you choose to do. And we're going to go into those 3 points: the new products, the leasing, and the competing with $0 or $99 down companies in a little bit more detail. We're going to explore some of the numbers behind that financing to exploit those growth strategies. We're going to start out though by diving in a little bit on hiring people. So Jim Senior, over to you.
Hiring salespeople, that is an awesome and a little bit scary process if you haven't done it. And I will say on a personal level that I have done it, and a lot. Pardon me. I've done it a lot, and I'd be happy to speak with you one-on-one. It's an interesting endeavor, but the most important thing when you hire a salesperson, other than the hiring process, is these people need someplace to go. And so you have existing customers. You will provide them with places to go in your own customer base, or we've discussed acquisitions. You acquire a company and it's got 300 accounts, and it's almost essential that you visit those if you want to maximize your value and thus fundamentally reduce the multiple you paid, because you'll get so much additional. So visiting customers, and how? There's 3 good reasons. Their contact lists upgraded. Make sure that they have the proper permits, police department permits, etc. And to make sure they get the maximum insurance discount from their insurance carrier. And these are reasons that you use to present it to your subscriber for you to make a site visit. Remember, these are existing customers, and you're going to want to do certain, you're going to look at their schedule of protection, how it works today, is it where it should be. You're going to look for video fire and all the obvious add-ons. But one thing I like to do to find the dominant buying motive is to say to the customer, and you look the person, whether it be in a residence or the person's individually right in the eye, and say, what is the security problem that most concerns you in your home and in your neighborhood, in your business, in your neighborhood, and then be quiet. And a part of selling is listening. A big part is, so you're looking, and you'll be surprised what you'll find out. And the partner or the spouse may look at one another and say, I didn't realize that. Well, that's critical. So the next bullet point, Jim, is referrals. Okay. Referrals is the lifeblood of the business. And I was in a franchise that used to say, wise old owl, obsessed with leads. So you have a customer base and you have the right to, again, look the customer right in the eye and say, who is the first person that comes to your mind that will enjoy the same peace of mind and protection that you're enjoying in your home, in your business. And then WFA, wait for answer. And when you get a referral, then you have the right to say, gee, thank you very much. Anybody else that comes to mind. And if you do that every time, all the time, every time, I promise you, you'll get referrals, and everybody loves a referral. A sales rep, it's the most, it's like, thank you. Okay, let's talk about an introduction to other sources of recurring revenue. And let me get my notes here because I've got them. Another layer of services. Now, you know, they're the obvious ones, but we have a company called Observables, and Observables is a company I invested in. I didn't have to do it. I did it, and after a lot of time with these people, because I wanted to. There's a little bit of a profit motive for me. And I'm also was retained as an advisor. But this level of services, you can very easily fold it into your offerings. It's a one-stop shop opportunity. It has a suite of services, and included in those services is more RMR, and because there's more than one or two or three services, sticky. As a dealer, I learned the largest expense I had was attrition. Go figure. I thought it was my payroll, but figure out what a value of an account, not just the 32, 3, 4, whatever you're going to get for it, but over the life of that account, maybe it's worth 60 times. So $50 a month is worth $3,000. You don't want to lose that. So this helps you to be sticky. And I'm going to give you some examples of what the additional income and sticky streams are. Video surveillance, POTS replacement, access, satellite, communications, gunshot sensors, lockdown notification, POS replacements, that's point of sale retail, the temperature, phone services. And I'm going to take just a second. So you go deeper. I mean, this is a website. It's just visit it, talk to the people, and add all these services, and your income stream and your value of your company are going to increase. I'm going to talk about using cold calling. That's how I started out, door knocking. We had no accounts, no referrals, no nothing. And I'd like this is being used by some dealers we interface with today on the loan side. And if I were a cold calling commercial sales rep today, I would walk in the door and introduce myself and say, I'm here to analyze your phone expenses. Please give me 2 months phone bills. I'll take them back to my office, do an analysis, and if I think I can save you money, I'll contact you. And if I don't, I won't bother you. Now and by the way, in many cases, but I'm not just another alarm salesman. Not that there's anything wrong with alarm system. I love me as an alarm salesman. But this is a gentle in, and now you've created a relationship with this person. And did you hear the list of what I just read that you can provide in the RMR and the stickiness? So that's just a sales technique, a cold calling technique. Jim?
So, and as this relates to financing, for you to launch a lot of these additional services, there may be some startup capital that's involved in on your part. And so we want to kind of dig in a little bit into some of the numbers, as I mentioned earlier, about why this financing ties into this discussion of organic growth. And really the premise is that you could add customers or you could increase RMR if you had access to money to help you cover upfront costs. In other words, you want to take those upfront costs away from the customer, and if you could bear those upfront costs, you're going to increase your likelihood of being able to sign that customer, and you're going to increase your RMR in place of, or as a compensation for, absorbing those upfront costs. So with this slide, we're trying to put together a few examples to illustrate the concept. And again, the concept is you have some upfront cost. And if you have access to capital, you could decrease that upfront cost to the customer and exchange it for a higher RMR. So we worked with a dealer on a project where they wanted to go out and replace all their fire customers' landlines, dedicated landlines for the fire alarm control panels with AES radios. And so it wasn't just fire, it was for, across the board. But they wanted to do a big push on this, and so they had an investment in the radios and they had an investment in the labor to install it. And so in this particular case, they went out and they increased everybody's RMR by $20, which they were happy to pay, by the way, because they were saving $100 in dedicated phone lines. And they had a break even of 17 months. And then after that, because of the long useful life, they're going to make that much more profit. So that's the concept there. And it's the same idea with a $99 system. Again, we're not saying go out and sell $99 systems. What we're saying is you may be facing competition from companies that are doing that. So maybe you're not going to do a $0 down or 99, but you might try to get $200 or $300 up front. You still may have upfront costs. And this is how you can have, if you have access to credit, a line of credit, then you can tap into that, cover the cost, and then you'll have a break-even point, and then you'll have profit over time. And video monitoring obviously is just becoming more and more popular these days, and so the model applies there. And a lot of the dealers that we're working with are using this to have an upfront cost that they cover, and really doing it as the model as a cost per camera per month subscription. So again, they're turning a lot of these opportunities into RMR opportunities. So the last example on this page, lease, and this can be for Berg, fire, access, CCTV. It doesn't matter really, the principles are the same. I want to drill down on that really specifically for a moment. So you have the option to sell, right? And let's just say in our hypothetical commercial lease example, you have costs that, what your costs for equipment and labor are going to be of $2,000. And then you mark that up and you're going to sell that for $3,000. And so that would give you a 33% profit, $1,000 profit, and plus you pick up, let's just say for the sake of this discussion, $35 monitoring. All right, so that's fine, and that may be a traditional way of selling a small commercial system. And again, whether it's CCTV or Berg, that's not really the point. But let's take a look at a lease model if you decided to go that way. So maybe you can get something up front. In our example here, you get 20% up front, right? $600 off of a $3,000 install price. You get $600. That leaves you with $1,400 of cost to recover. Remember, in our example, you got $2,000 of cost. And if you have a goal, let's just say you want to break even on that, in 24 months, you could charge $65 for the lease. And then you'd also pick up your $35 for monitoring, and you'd have a 24-month break even, right? So now what you've done is you've created $100 of RMR as opposed to $35 of RMR. And if we took a look at the profit comparison over, in this example, let's just call the useful life of the system 10 years, the lease option is going to spin off $6,840 in profit versus the $1,000 for the sell option. And that's obviously a significant difference. And this doesn't even take into consideration the monitoring profit, the $35 a month that you get for monitoring, the profit that comes from that. Because in this example, you get the monitoring either way, but that might not really be the true situation. I mean, you may be not winning the business unless you're offering a lease option, because a competitor might be offering a lease option. So in some cases, you have to look at this as like, well, this is a way, not just am I going to get, profit A or profit B, it's am I going to get anything at all? So that's why this is a pretty significant difference. And in addition to that, with the lease, and Ken can speak more to this, and his contracts back it up, With the lease, you're also going to get protection against a takeover, right? So if a competitor comes in and tries to do a takeover, they're going to have to remove your system and buy a whole new system in order to take over that business. In addition to that, now someday down the road, when you maybe are looking to sell or retire, you have $100 of RMR from this account to sell instead of $35 a month from this account to sell. So, and yes, will there be expenses associated with the fact that you have a lease and you have a maintenance obligation that goes along with it? Of course there will be, and that would be different than if it was an outright sale. However, with the different of profit that we're pointing out here, you're more than happy to spend money each year providing maintenance services if this is the rewards for that. So the slide is kind of encapsulates really the message that we're trying to present, and that is, if you can access capital, you can cover upfront costs, which allow you then to either get in the door or sell new services that you previously wouldn't have been able to sell, or get business that you might not have gotten, and you can increase the RMR. So this is why we kind of feel so strongly about that. So I'm going to kick it back to Jim Sr. and to kind of take the rest of the way.
The rest of the way will be quick. You have an ability to borrow, which is an asset. I was told that years ago by a very successful person. Go into leasing, and I listened to this person, and so I borrowed money, leased systems, generated a lot of business and a lot of recurring revenue, and ended up, as I said earlier, with a decent sized company. So if somebody sent you a check for $1,000 right now, today, a subscriber, and you just kept it on your desk, never cashed it, that's exactly what you're doing when you're not using your ability to borrow. And Jim we've done hundreds of these deals, and we're really pleased to speak with you about it. But wouldn't you cash that $1,000 check? Wouldn't you materialize this unused asset, your ability to borrow? Also, just a little bit of a go back. And hiring and training and maintaining and terminating sales reps is I've had a lot of experience with that in my many years with many men and many women, and I'd be more than happy to speak with anybody individually. I'm not going to disguise it. It's a challenge, but boy, don't you love the idea that you have 2-3 people out there generating income while you're sitting in your office or getting your Bentley polished or whatever. This has been a pleasure. This is my career. I love it. I still love it. Thank goodness Jim Jr.'s in it. And thanks, Ken, ever so much for this platform. Very much.
So Ken, we'll turn it back to you and see if your audience has any questions for us.
Okay. I want to thank both of you for another terrific webinar and very informative. I want to come up with a couple of comments on my own. Providing additional services to generate RMR is an excellent point. And I do want to make a plug for the all-in-one contracts, which itemize the various RMR possibilities. And if you take advantage of each one of those, filling them out, my feeling was when we designed the contract was that adding the components of RMR will add up a lot higher than if you come up with just one RMR number. So we do break out the different services that you can provide. For example, monitoring service, the repair service, inspection. We even break out for verification. We have cyber on there, things like that. Okay. Using your financing to grow is an interesting concept and works, I'm sure, for a lot of aggressive companies. It's true that when I think the most successful, well, some successful alarm companies use the model of sale and lease, and or cheap cost or below cost installation, so that they can grow the RMR as opposed to holding out for the big installation charge that you would get up front. And so financing can help you there. I do want, I guess I have a natural a resistance to borrowing money. As a United States bankruptcy trustee, I'm certainly sensitive to people who overuse their ability to borrow and incur a debt service that they can't possibly pay. And I'm willing to bet anything that the Worcesters are very astute in evaluating their applicant for financing. And I'm sure that when you do apply, if you get that loan from Alarm Financial Services, they're betting on you. They have a very good idea that you've borrowed the money for an appropriate purpose, and it's going to be something that's beneficial to you, because the last thing they want is for it not to be beneficial to you. These guys are not in the business of grabbing your defaulting accounts. That's not what they do. Two other points. One, Jim Jr. used the word maintenance, and we do not use the word maintenance in this.
I thought about that you wouldn't like that as it came out of my mouth. Sorry about that. I knew that was a hot point for you, Ken.
Just before the webinar started, I had to review a contract, and the alarm company used the word maintenance, and the first thing I did is change it to repair. So it wasn't a maintenance contract, it was a repair contract when I was done with it. So we don't want to get stuck with maintenance. In the alarm industry, we inspect and we provide service, repair service. We don't hang around someone's premises oiling and greasing and tightening to make sure things are going to work. Okay, if you do that, then you can do maintenance. But if you don't do that, and I know you don't use the word maintenance. Borrowing to grow, which was one of the original concepts of the whole webinar series, is of course an interesting way of looking at the assets of your company. Quite honestly, I never thought of it that way, but I think that Jim Sr. is particularly right about that. I think that your ability to borrow and use the funds appropriately is an asset that you have that can help you grow even more. And what's important, I think, about dealing with the Worcesters is I think that they're there for you. That's a big difference. They're there to assist you, to guide you, to make sure you succeed. That's a very important contribution that they make to the relationship. So it is not simply a lender-borrower relationship, which usually has an inherent conflict of interest. Okay, so be very careful if you go outside for lending, and if you're in this industry, certainly Alarm Financial Services is something that you really need to consider. Here's some questions that came up. Do you have to file UCC forms with every system that you sell, residential and commercial? Okay, that's not a financial issue, but the answer is no. You don't want to file UCC forms because most of your customers are not going to like the idea that you filed a UCC form against them. It may violate their lease. It may violate their mortgage. It may violate some prior lending agreement that they have. So the UCC form to create a security interest should be used sparingly when you become financially insecure with that particular customer. On a different level, you can expect Alarm Financial Services to file a UCC against your company when they make a loan to you, right? You should. If you don't, you should.
Correct. I mean, occasionally, if there's a bank that you're also doing business with, we'll be specific on our UCC filing so that it's on the accounts, and then the bank may be securing their loan with other assets. So the point being, if you're working with a bank, that doesn't mean you can't work with us, and vice versa.
Okay. Here's another question. How is the RMR for a lease valued for the purposes of a sale? They want to know if it's more or less than RMR on a non-leased account.
Right. I mean, that's a great question. Ken, you probably have your perspective on that, being involved in a lot of transactions in which part of the RMR is going to take the form of a lease. From my standpoint, I think it's the same answer that you would give to any different type of RMR, whether it's RMR from fire system test and inspection, or RMR from any number of video monitoring, any number of different sources. The buyer is going to look at what their profit on that RMR is going to be, and that's how they're going to value it, right? So the higher the profit, the higher the value. In the case of a lease, the cost associated with a lease is going to be whatever expenses they might incur, sort of on the dealer's side of the obligation of the lease. So do they have repair service responsibilities, replacement service responsibilities, et cetera? And so some estimate about what the buyer would have to expend if they take over that lease. But our experience has been that the lease RMR is very profitable. I'm sorry, gets a high multiple because that profit margin is significant. So right. It does vary, but so Ken, on your perspective is I'm sure very valid.
Right. Well, you're right. And one of the reasons that you just alluded to is the lease provides a higher profit margin on the RMR, and that's because the seller has already absorbed the expense of installation. So when another alarm company comes in and buys the account, that installation charge is gone for them. They have certainly they have the acquisition charge that they're paying on the multiple for the RMR, but they aren't trying to recoup their installation charges. So the lease generally will have a higher RMR number because the seller has already calculated in the cost of the installation, number one, and number two, buyers, end users rather, they're used to paying more in RMR for a lease. They understand that they haven't had the expense of the installation. Even if they've paid an installation charge, which I think you should get, they're not paying the full installation charge that they would have had they bought the system. The other part of the lease relationship is that a lease creates a tighter hold over the end user than a simple service contract. The courts will look at it much differently, and so will the parties. All of the equipment is owned by the alarm company. It's not owned by the end user. So the end user would lose the equipment if the relationship ended. So the lease is a stronger relationship. The lease is when you go to sell the lease, the buyer doesn't have to be concerned with the installation costs. It's already calculated in. Generally, you're going to have a higher RMR. The answer is you'll get a higher multiple for a lease than you will for all service contracts. And I'm including in the service contracts monitoring, inspection, everything other than the lease charge, okay? And of course, in the alarm industry, we don't typically break out the lease charge. We typically, it's in there as part of the overall services that are being provided. So yeah, if all the accounts are leased, you can expect a higher multiple. If you have 99 monitoring contracts and one lease, don't bother asking for a higher multiple on your one lease. It's not going to happen, okay? But if you have 99 leases and one service monitoring contract, you're going to get a higher multiple. Hope that answers your question. Okay, borrowing to grow is something that doesn't interest me. However, I do understand that as I grow, I may need to borrow to grow. So then it will be interesting to you. Is borrowing from AFS the same as I might borrow from a bank? What makes AFS borrowing different and better for my business? Well, that's a great question for you guys. I know you can answer it. I'm going to give you a head start. First of all, your bank isn't going to lend to you. How do you like that? Not if all you have is your alarm company. Sure, if you've got a house to put up, or you've got a bank account to put up, or your first child to put up, yes, they'll lend to you. But if you walk in and say, hey, I have an alarm business. I have 5,000 accounts. They each pay me $40 a month. I have this tremendous revenue stream coming in. I want to borrow money. Well, rest assured that whoever you're talking to, his next response is going to be, huh? You got a house? You got a bank account? What do you got? Can I see your tax returns? Can I see this? Can I see that? You're going to walk out of there going, what the hell is Worcester's phone number again? That's what you're going to wind up. That's what you're going to end up doing, okay? Because when you call AFS, I need to borrow. Okay, they know, they speak your language. And they are interested in the assets that you are interested in. And they are interested in the business that you have, that because they understand it. Your banker doesn't. Now, I hope I didn't cover everything that you would have said, but there's some of it.
No, I think you covered it exactly. And there are situations where a bank will borrow or will lend to you, but they're probably going to be looking more to maybe your personal assets, your real estate, your stock portfolio. Are you doing your other business banking with them? And then so they're going to key on that. And then, but the real inhibitor is going to be, that would set it at sort of a low level, right? So to accomplish some of the things that you want to accomplish to grow your business, whether it be, by a bigger transaction like making an acquisition, for instance, it's really unlikely. They're just not, as Ken said, they're not going to understand the economics of it or the RMR necessarily. So that lack of understanding is kind of why we exist. That is the void that we fill, is that the local banks really aren't able to step up and meet the demands of the small, medium-sized alarm dealers.
Well, let me just make one thing clear as and again, this is a good way to get closer to wrapping up. Look, you can go to your local bank and borrow money and use it for your business, but you're not going to be borrowing based on your alarm business. Right. You're going to be borrowing based on your own personal financial situation, maybe against your house, and you're going to, if you go in that direction, you're going to borrow for less than you're going to get a loan from AFS. It's just simple as that. You can go get yourself a home equity loan now, refinance your house right now. You are really putting yourself on the line at that point, obviously. You're putting your major assets in life are your business, and typically right after that is your home. Okay, so when you go to a traditional lender, there's certainly, you can expect to put that home at risk. Okay, and that's an important consideration, because if things go sour, you've lost your ability to shelter your home with whatever exemption you might be entitled to in your state, and your exemption from judgments might be the full amount of your equity in your house at that point. Whereas if you've now given a mortgage to the bank and you've pledged your house, you've lost that and you've got nothing left. Not only have you risked your business, you've now risked your personal assets as well. Now, if you go to an outfit like AFS that understands the alarm industry, they're going to be looking to your accounts as their primary collateral. You may be, I'm willing to bet that they do very few deals where they take a mortgage on a house. They might, I'm sure they get a personal guarantee on the loan, but I'm willing to guess, I don't want to put you too much on the spot, so I'm not going to ask whether you've ever taken a mortgage, but would you typically, in most cases, take a mortgage?
No, we never have. We've never secured personal assets like that as part of our deals.
Right. So that's what I suspected. So that is one reason for going to AFS or a lender. I don't even know if they have any competition, but if you go to a traditional bank, you can expect that it's your personal assets they're going to be looking to. They're not going to be interested in your alarm business at all. I don't know, the Worcesters would probably know better than I. You know, in the manufacturing business, in New York, for example, what we call the schmata business, they have factors. So factors would buy up accounts receivables and fund the manufacturers that way. I don't believe that that's in the alarm industry. And if we have anybody here that is selling their accounts to ADT, or you're selling your accounts to whoever else is doing it now, I don't even know if Monotronics is still doing it or not. But to me, you're not building a business that way. You're making income because you're churning accounts and you're getting paid for them by the program, ADT being one example. But if you're not retaining accounts, you're not building your own equity. So that we're talking about building your own equity, building your own alarm business here. We're not talking about making a living week to week or month to month or even year to year.
Well, yeah, we didn't really even have time to drill down onto that specific point, but certainly this is an alternative to selling accounts through a dealer program like you mentioned, right? I mean, the idea is, well, you're selling that account and you're recovering the costs that you incurred to create that account. So what if you could have access to enough capital to cover your creation costs without having to sell it, right? You'd keep, like you said, you'd keep that account and you'd be building your RMR and therefore building the equity in your business. Ken, if it's okay, I just want to pick up on 2 points that you mentioned. One was, you said, well, you know, if you went to a bank, you might be able to borrow for a lower interest rate. And so, you know, we took a look at that, and I just want to kind of show you here, you know, the kind of loans that we're doing here, we're talking about really short-term loans, right? So up to 5 years maximum. So the interest rate is not going to have as big an impact in that monthly cost to you for borrowing. So for instance, you know, I did these calculations of putting our interest rate in here to figure out how long the break-even point would be. And then so on these calculations, I used our interest rate, which is prime plus 6 or 9.25%. If I lower that to cut that markup in half from prime plus 6 to prime plus 3, these break-even numbers would go up by 1 month each. So it puts it in a little bit of perspective of, yeah, okay, you know, what's the impact if I could, you know, get a lower interest rate? And so you're right, maybe going to a bank and tapping into personal assets will yield a lower interest rate, but that's going to mean 1 less month on your break-even. And so that kind of, sorry, go ahead.
Well, I'm laughing because I'm thinking my next comment, which is going to catch you by surprise. So I don't want to sound like a commentator on CNN or MSNBC who has the chance to interview Trump and ask questions, because I did invite you to this forum. But let me point this out. Your analysis is absolutely correct. It's a 5-year loan. It's an amortized loan, I guess, I'm sure. So the interest factor, yes, even though you're paying 9% on the loan, you know, it's not a big deal. It's not a lot of money in the scheme of things over the entire account. Matter of fact, raise the RMR $1 or $2 and you've got it covered. Okay, that I got it. But if the company that started with Jim Sr. and they're going to end up with Jim Worcester III, and they've been with AFS for 30 years, and they've maintained a $100,000 loan over a 30-year period because they keep refinancing. So now they're refinancing at this 9% rate, let's just say. So in the long term, you could end up with a higher rate than if you went and you got yourself a home, refinanced your house and you had a 3% mortgage and you decided to use that money. But I do agree with you absolutely that the finance charge is almost irrelevant, especially in this business. It is made up easily in the RMR that's being charged on an account, and the additional services that you're able to run, and the referrals that you get from your customers. And as long as you don't have a company with an atrocious attrition rate, the amount of the financing is, particularly if you start to look at it from deal to deal, is meaningless. Really, it's negligible. I agree.
Well, and that's actually the way most of our transactions occur. They aren't just refinanced over that period of time, over a long period of time. Most of our long-term relationships are because each year our dealer is coming back to us with a new project or a new endeavor that they want to finance. It might be an acquisition, and then the next year they're just launching a new initiative that they need, or opening a new office.
I'm in the middle of a webinar.
All right.
Okay, take care.
Jim, I have a comment. Okay. Can you hear me?
Yeah.
Okay. There's a reason we're the oldest alarm financing company in the industry.
Is it vitamins? What's the reason?
And the reason is, and by the way, I'm the oldest human in the alarm business. The reason is because we are alarm guys and alarm ladies. Our office, the people in that office, Jim's team, we're alarm people. And so we may say no to a loan, and we'll tell you why, and that may save you a lot of trouble. And when we say yes, it's because we as alarm people understand what you're doing, because we've done it. So what would be the worst thing if we called up and had a little conversation, we did a little examination, and we gave you some professional information and that helped you? I'm having trouble. So just hop on board, give it a try. I'd love you to experience the financial blessings that I received, and I did it with RMR. Okay, it belongs to you too if you choose to involve yourselves. We're here for you.
Even if you're not thinking about financing or thinking about it that way, you ought to give these guys a call and find out what can they do to help you grow. Because if you're not thinking about growing, then you're certainly making a mistake. You do need to think about growing. I guess I'll use that ding dong as our concluding the bell, I guess. Wait, we have one more question. I can't answer this one. I'm not sure what it means. Are these leases capital leases or operating leases? I don't know what that means. You're leasing your equipment to your customer. Do you guys know the difference between that question? That's the last question you have.
Yeah, I mean, you want to get a definitive response from your accountant or an industry accountant, somebody like Mitch Reitman, who's a frequent contributor to this forum, because there's a definition of operating lease and versus capital lease, like an accounting definition. So I'm not sure what the difference is. I believe that they're capital, but that's up to the end user of those as to how they book those. But you can get a definitive answer from somebody like Mitch Reitman.
Yeah, to add to the confusion, I don't know what difference it would make if they're characterized one way or the other. And I'm not going to ask the Worcesters to address it because it's beyond this forum to give tax advice. I've
It's a
managed
tax.
not to be sued yet. We're going to keep it that way. Well, we have managed to take up 3 hours of webinar time, gentlemen. And I know that you had some, I won't say misgivings, that's the wrong word. You were wondering, is this going to work or what? So I'm glad to let you know that it has. It's been a great success, and I want to, and it's all because of you guys. You guys are terrific. You did a great job. I hope you get a lot of business out of this. Anyone who's on here, give these guys a call. Spend time with them. You have nothing to lose, as Donald Trump says. You have nothing to lose. Give them a call, and I'm sure that they can come up with at least one good idea for you. That's a Ron Davis thing. Just get one good idea, and it's worth the call, right? So I want to thank everybody for joining us. All of the webinars will be posted on our website. They've been recorded. My daughter's job is to put them up, and she's been busy, but I'll get her to put them up in the next day or so. So you'll be able to see them. I'm going to comment on the webinars in future articles, and also we'll send out the link so you guys can make your way to my website if you haven't already. If you don't know how to or where to, we'll let you know. So even though you guys didn't pay for this webinar opportunity, I'm going to let you have the last word. How's that?
Thanks.
Thank you.
Well, I'm sheltering in place, and my wife would really like to get me busy, so I'm here.
You guys are welcome to put on as many webinars as you want. Just let me know. We'll be here for you.
Thank you. We appreciate it.
Okay.
Hello.
All right. Everybody stay healthy, and bye-bye.